रिकॉर्डिंग में कल मुझे
Sir, please start.
Okay. Uh, Welcome you all. Today we are in time. Sorry for the delay. Yes, in the previous class. Well, uh, as you know that this is a 2-hour session, and we have 4 units in this. The first half of the strategic management performance management module of 20A, which is optional. And I have 3 sessions to deal with. One, I dealt with unit 1 of the issue, and today we are going to deal with unit 2 and preferably unit 3. So, a lot of issues to be covered up today. And what I do and what I have done is that I have prepared comprehensive study notes in addition to the material which you have already in your hand regarding the final course. And I have I'm going to just talk on some of the issues, maybe critical issues, and I'll hand over the documents to you after the class through my Google Classroom and as well as through the official channel. And so today we are going to talk on unit 2, which is we are going to come on that, and unit 3, which is a little bit economic in nature. Unit 4 is on risk management. We are going to leave it for the 1st of December. And I have tried to cover up some of the questions which have come in the MTP as well as the June 2023 term. I have tried to cover up those issues as well. And as you would see that much of the questions are from a little bit from these issues as well as from risk management issues. So after my sessions are over, you will find that all the questions which have come are, you can easily access them. And furthermore, I have my Google Classroom, I have my email ID, you have your official channel. So, before the 1st of December, before my final class, please shoot questions. If you have any, if you are listening to this classes, and then shoot questions and make this interactive so that in that way we will be able to, interact, and we will be able to, it will be helpful for you for that matter. So let us not waste any more time, and let us start with unit 2. So unit 2 is about some tools and the DuPont analysis. Some of these questions are coming. So what I have, it's a huge document. So I have around 80 pages of document. Of course, these are in 14 fonts. So you will have these documents with you, and I will cover up those questions which are coming in the examinations, and some issues regarding balance scorecard, you can read through them. So the benefits of balance scorecard, etc., etc. We're not going to talk much on that, but I have covered. It's a 45-page document. So let us not waste time, and let us get to what I am talking about. So as you see that I have a Google Classroom, and you can join my classroom. It is nothing. It is only to communicate these documents with you. So you will have these documents with you, and you can directly click. This is PDF, so you will not be having the option of clicking. So you can copy and paste this. Many of you students have already into my classroom, so you can directly communicate with me regarding my queries. Of course, regarding what I'm talking about. Now in Google Unit 2. Unit 2, this is Unit 2 to be precise. So in Unit 2, we are going to talk about the emerging tools. So we are going to talk about the emerging tools. The balance scorecard is a different, it is of course an emerging tool, but it has dealt differently. A lot of talks is about quality management. So a lot of issues are there regarding quality management, TPM, total product quality management, total productive maintenance, etc., 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 etc. And finally, there is a new topic which I haven't found out in other courses yet, which is data envelopment analysis. Of course, the advanced level of it is beyond me, as well as it is absolutely mathematical programming. So I'll try to give you a basic idea of it. not much questions are coming as well, but we will try to understand the issues. And as usual, we will be, as this is balance scorecard, we are going to talk about it, the DuPont analysis. I'll spend a little bit of time here. So because this is a question which is coming quite a lot, so I'll be spending a time out here. This is a time, a very interesting thing which I have, tried to assemble for you. We're going to talk about all these issues. These are, of course, this not this one. Forget about this one, but all these issues are basically about improvement in the process, improvement of quality, how to better your thing, and of course, gain competitive advantage. So all the issues are related to gaining of competitive advantage and how you improve on these issues. And why these are covered? Because these are related to the efficiency of the firm. These are related to the efficiency of the firm. And in you have this data envelopment analysis, where we talk about why this is included, because this is a very relatable efficiency management technique, efficiency performance management technique. Now, if we look at the unit we are talking about, you have balance scorecard to talk about. So balance scorecard is a area we talk about. We have the DuPont analysis. There are two ways of classification. This is nothing but breaking down your. This is nothing but breaking down your breaking the ROE, return on equity. So we just try to get an insight into the performance of the business on the basis of breaking down the ROE. We'll spend some time on the DOE. And then you have this, this is a comparison tool. So you are doing well, and now what about the others? What about yourself 5 years back? What about yourself 2 years back? So comparison. In comparison, we talk about benchmarking and bench trading. In quality improvement, so I'll rather say improvement. So in improvement of quality, we'll be talking about total cumulative management, the PDCA cycle. So it is, plan, do, check, and act. So I'll talk about a little bit, a very few minutes, maybe 5 minutes, maybe 3 minutes. Statistical quality control, which is the father of everything. It was started in 1920s. We're going to talk about it. And total productive maintenance. So this is called TPM. We are going to talk about TPM a little bit. But of all this, it's all change, digital environment. So we have a digital environment. So this is a very interesting separate area where we talk about how the management information system has changed in the new digital environment scenario. And finally, you have data envelopment analysis. So DEA you finally have. So this is the scheme of things. If you look at your unit 2, you will have these issues. BSc, it is a different issue. DuPont analysis, quality, comparison, data analysis, and management information system in digital environment. Of course, these are theoretical issues. So maybe I will be spending a little bit more of time on DuPont analysis. The timeline, here the timeline comes because all these are relatable. So these are relatable. So where does TQM, PDCS, SQC, TPM, total productive maintenance, where does it all lies? So a little bit about BSc. I'll try to give you an overview because you are all ready for the examinations. So this is going to create a synopsis. So I'm just trying to create a synopsis for the examinations which are coming, which are in your hand. So I'll spend some time on data envelopment analysis because this is a new area, and of course this is huge. They have, it's a mathematical arena, and books are, a whole book is written, many books are written on DEA. A lot of research work is being done on this. So just why? So we are going to just talk about the why of the thing and how, a little bit of it, without going into the entire. But first of all, we need to understand why why we start with BSc, why BSc is so important, why the balance scorecard is so important, why. So the traditional model which went long back, the traditional model of the firm was maximization of shareholder wealth. So shareholder wealth maximization was the traditional model of the firm, and all the study materials, everything, the financial management and everything, the portfolio management and everything conceptually is based on the traditional model of the firm. But the problem is you only think of finance. So you only think of finance. So the model is why? Because your shareholder are the boss. So you think that if you can keep them happy, if you can keep your shareholders happy, everything is fine. So this is the shareholder wealth maximization model, or the traditional model of the firm, where you just manage your firm in such a fashion that the shareholder is happy. And if the shareholder is happy, everybody is happy. But since 1984, of course, a lot of research has been taken on, but this one Freeman, of course, there are a lot of contributors, but Freeman's contribution is main. He came up with the fact that no, the shareholders are only one uh, important person of the firm. There are others, who the customers, the creditors, the society, and etc. etc. So shareholders, yes, they are there. They are very important. But you cannot run your farm based only on the fact that shareholder is your boss. Of course, they are your boss, but there are other people as well, and the government and the environment. So all these issues came up, and these are the stakeholders. So these are the stakeholders. So these are the stakeholders. Therefore, all the models, all the books, all the things are written on the fact that shareholders are the whole issue, only issue. But since 1984, Freeman was a person who came up with a book, and where he said, look, there are other people, and therefore you have to think about them. And naturally, you have the 3P, the planet, the profit, and the people. So planet, profit, and people. So your this is a triple bottom line, or you have a bottom line where you have to be careful about the planet, you have to be careful about the profit, and you have to be careful about the people, so who are in your business. So the whole issue change. The shareholders is your profit is only one aspect of your the whole scenario. And given this fact, you have your BSc. Now you consider what has happened. So this is what I was talking about. Richard Freeman in his work 1984, the concept of shareholder. Now you come to the concept of balance scorecard. On the basis of this, in 1990, some things happened. Copland and Norton developed this model, which is balanced. They say, look, it is not only uh, it is, you cannot just think of your profits alone. You cannot think of your shareholders alone. You cannot think of your finance alone. There are a lot of important issues as well. And so you have to think of them as well. And this is how it developed. 90, 92, 93. It's a very important thing, finally in 1996, this book came up. He was related, he was, this balance scorecard, translating strategy into action. This book came up, and which is finally how you put your balance scorecard into action. What is balance scorecard? Well, these are the four perspectives you have to consider. in your balance scorecard. Of course, why you are doing it? What is your target? Your target, your objective, or your goal, or your mission. Your mission is your strategic objective. I will call this strategic objective. I'll not confuse you with the jargon. The strategic objective is to stay in business and be profitable. So if those are relatable, if you are not profitable, you are going to not going to stay in business. So the strategy objective is staying in the business and being profitable. So given this fact, they say that there are four perspectives you have to look into. So, and for this, what you have to do, you have to be competitive uh, um, advantage. You have to gather competitive advantage. So this is the Porter's model, which we talked about in our previous class. You have to gain competitive advantage, and for that, you can use the balance scorecard. So what you're going to do is that you're going to use the balance scorecard. So for that, you do the balanced scorecard. So it is balanced. That means it covers various areas. What are the four perspectives? Number one is, of course, the financial perspective. Yes, surely the financial perspective matters. Finance matters. And of course, profit, of course, your shareholders, you have to be very careful about them. You have to, you got to be profitable, you got to go on increasing your profits, and etc. etc. Done, surely so. But you have to also consider the customer, because he is the boss. So the customer's perspective is what matters much. So, the customer, you have to also think about the customer. Sorry. So you have to also think about the customer, because he's a boss and you have to keep him happy. Of course, you always remember one point, that that your total revenue, if you minus your total cost, is your profit. And therefore, this total revenue is basically your price into quantity. And the quantities, of course, this is quantity sold. Now, this price is market determined in most cases. So this quality sold will depend on your customers, on how many customers you can tap. So quality sold also depends on your quality. The quantity sold also depends on your quality. That is why we have so much talk on quality, which are going to, the total quality management and Six Sigma and all this sort, and lean management and Kaizen and all this sort of PDCA, etc. etc. You also have an internal process perspective. How well you are, gathering up your business, how well you are, entertaining your second customers, the manufacturing process. So you have to also look into that, be better in that. And finally is learning and growth, because learning and growth is a very interesting scenario, which is much important. And if you don't learn in the new organizational setup, you are gone. So these are the four perspectives, and each of them ask a question. So here it is about the shareholders. This is about the customers, how the customers see us. And this is about your internal process, maybe your after sales service, maybe your supply chain, maybe your, so it covers a lot of issues. Internal process covers a lot of issues. And finally, your learning and growth. How do we improve ourselves? How do we create value? Because the previous job said you have to go on creating value. You have to do something meaningful. So if this is not valuable for you, if you don't perceive this to be valuable for you, then I am gone. As a teacher, I'm gone. If what I have done all this up to this class, it's of no meaning if it is not valuable to you. So these are the four perspectives, and this is a very important, interesting question, picture which I have taken from the internet. I have so mentioned the source. So you also please, if you can draw this picture to cover up much of the issues. So you have your strategy at a point, and you have four perspectives. The four perspectives gives you four answers. And this is a question which came in 2023. Explain the four perspectives of balanced scorecard on the basis of a quote which was mentioned. So you have your, the four perspectives of benefits. Yes, it is seen that there are a number of benefits which is happening, communication improvement. So basically the benefits, if you look at in where it happens in the profitability statement, in the market shares. So that thing we are going to talk about in unit 3, the key success factors, key performance indicators, which I told in the first day class also. I gave you number of 20 KPIs. Today also I'm going to talk a little bit of it. If I get time in my unit 3, there is a perspective to talk about the CSF and the KPIs, the critical success factor and the key performance indicators. Well, again, there is a question which came, and just a little bit of it. Well, there was write down the steps in developing. This is a question which is very interesting. Write down the steps in developing balanced scorecard. Now, this is a thing given in your study note very clearly. The Balanced Scorecard Institute, which is an international institute, they have given 9 steps of implementation. So these are the 9 steps of implementation, and this I don't think you will get in any particular book. So please follow your study note. Please follow study notes. Study material, I would call it, because some issues are, very particular to this. For example, in this digital marketing, there's a case of Chic, CHIK, Chic shampoos of reverse strategy mapping from the market. It's a strategy which is developed from the market. This is also a very internet driven issue which is covered up in the study material. So regarding 20A, I would say, I don't know, I haven't got in details into regarding 20A, SPM part 1. Part 1, please follow the study material, and there are a number of citations and references given. If you want to cover up, you can really look into the issues. Now, what we do right after this is we talk about DuPont analysis. Now, why suddenly DuPont analysis? Basically, I think it should be covered with the ratios, because it is a part of your financial analysis. Of course, it's a part of your financial analysis. So if I was given a choice, I would have included this as a part of your FSA. So this is a part of your FSA. This is my perspective also. Part of FSA, financial statement analysis. Now, what we do is that basically DuPont, it's a 1921 in a DuPont factory. This was developed. It's very important because it shows you various perspectives, newer perspectives. Because everybody is interested in ROE, return on equity. So this is a perspective where everybody is interested, return on equity. So you buy your shares on the basis of profitability, on the basis of profits, on the basis of equity, return on equity. So your return on equity is all everybody is depending upon. And even in FSA, the first day class, when we were talking about ratio analysis, we understood that return on equity is a very important. term. And of course, you understand that here you take return for shareholders, for your, of course, your equity shareholders, and then you divide this by your equity shares. So it is as simple as that. It's a very simple ratio, but there are a number of issues which are coming up, which I'm going to talk a little bit right now. The first of all, your return on equity is now this equity multiplier is basically your leverage. A little bit different in the perspective that we use a concept of total asset by equity. This is the thing which we use here. Of course, you understand that your total asset is equal to your total liabilities. This is equal to your total liabilities, and therefore, what you are doing is you are considering debt plus equity by equity. Just the opposite of what we generally do. We take equity by debt, but here that is why maybe they are calling it equity multiplier. So equity multiplier is basically it focuses on how much debt you have taken to run your business. First of all, this is a basic criteria. Return on asset is basically return by your assets and your total assets, or I'll call this asset. So that will nullify each other. So your assets by equity. So if you do this, you understand that these two cuts each other and return on equity. So this is the first understanding of your. This is the first understanding of your DuPont analysis. So now you know, you try to segregate your return on equity into various perspectives. But this is the first criteria of segregation. So this is the first criteria of segregation. Now let us come to a little bit more detailed breakdown. So in detailed breakdown, this we call the three-way segregation. We call this the three-way segregation. Why? Because this is our DuPont. So let us call this DuPont return on equity. Your DuPont return on equity is asset margin, asset level. That means if your return on equity, for example, is your return on equity is 25%, or maybe 25%, then it's not always wicked, because you might also have a very high leverage, which is creating a positive impact on your return on equity. So your profitability might be less, and if your productivity is using your assets. So this is using your assets. So how you use your assets, and this is your gross margin or net margin, whatever you call. So this is your gross margin or net margin, or whatever you call that. I'll call this net margin. It's better to call this net margin. So this is your net margin, and this is your asset utilization, and this is your this is your leverage. That means debt structure. So your return on equity might be high. That doesn't mean that you are doing okay. Maybe you have taken more leverage, and maybe your asset utilization is higher, but your productivity is low. Just if you look at this study note, it will be very clear, because it depends on your strategy. It depends on your strategy. Surely depends on your strategy. It depends on your strategy. there are companies, for example, the previous day I went to a place in Kolkata, Esplanade, and I went to this woodland shop where it's very highly priced, but the number of people entering the shop is lower. So that means they are, they are keeping their profitability very high, but they are reducing on the utilization of assets. So their asset turnover is low. I'll show you. I'll just show you. So, and finally, of course, there are companies where they maintain high profitability, high return equity on the basis of their leverage. So DuPont analysis: what is net profit ratio, what is asset turnover, and what does it mean, what is leverage. Of course, here we use a different connotation of leverage: total asset by shareholders equity, and what does they signify. I'm not going to details in it because you'll be having this document after the class is over, and you can understand, you can go through this. So, but we're going to understand why understanding of composition of the DuPont ROI is so important. We look into the strategy, we can understand the strategy. We can know if it is increasing, what has helped ROE to increase so much. If it has declined, what has helped it to decline? So so it is basically a composition analysis. So we try to break down it into its components. We try to analyze that. Now, and as I said, that there are three components. Of course, one is your net margin. One is your net margin. That is how good it is doing. Just think of there is a shop, shoe shop. Students who are from Kolkata knows that there is a shoe shop called Sri Leathers. Now, for Sri Leather, it's a huge. If you go to the Sri Leathers in Linster Street in Kolkata, you will find that there are a huge number of customers. There are huge number of customers, and what the price of the shoes are very less. So this is low for them, but their asset turnover is high because they are utilizing their assets well. They have an asset, and there are a number of, so it is basically your assets too. So it is sales by assets. So your sales is very high in respect to your assets. So this is high, and of course, if there can be a situation where you do nothing, which is a very serious cause, because as you go on increasing debt, you are senior students, that as you go on increasing debts, your return on equity might go up, but that would be at the cost of your risk. So if this is high, then this also implies high risk. So be careful about that. Now, I have taken two companies where the issues are given. I have calculated the DuPont analysis. This is the ROE, and this comprises of three issues: 1, 2, 3, 0.25, 0.667, and 2. And of course, this is a multiple. The DuPont ROE is a combination of all these three. And of course, the DuPont ROE is same as the ROE. And I have taken company B, which is again the same thing, which also gives your return of the same ROE, which comprises of profit margin, asset turnover, and equity multiplier. So if you just look at that, 0.25, 0.67, 2. So A companies 0.25, 0.67, and 2. And B companies, it is 0.2 and 0.67 and 2.5. So this is your profit margin. This is your asset turnover, and this is your leverage or financial. So now you can easily compare. That means company A is this is same. The asset turnover is, so they have both utilized their assets similarly, but B is taken more loan. So this is taken more loan comparison to this, and therefore since this is lower, this has mitigated, and both company have ROE of same ROE. Both company have same ROE. And this is what I just said. And remember that higher leverage implies more of financial risk. So B is riskier. So B is riskier than A, though both are of equal ROE. And that is the benefit of doing your DuPont analysis. But of course, there is a problem, and what we see is that ROE, which we have depended so much till date, includes the effects of ROE leverage. My God. So the financial leverage, of course, not operating leverage I'm talking about. And of course, there is no question of cash generating ability, which we talked about the previous day when we talked about your cash flow ratios. And this is the model. Again, this is taken from the internet. ROE is divided into, this is what we started with, multiplied by leverage is ROE, and leverage, we leave it like that. ROE A is again multiplication of net profit margin into asset turnover. And now this is your three-way class segregation. And this is your five-way segregation. So in the above analysis, if you get the above analysis, we just include the concept of what interest is doing to the ROE. So interest has an impact on the ROE, and we are trying to understand what the impact is. And of course, your EBIT tax has an impact on the ROE as well. So we try to understand that. So here we multiply these three with leverage and asset turnover to get ROE. So these remains, the white issues remain, white blocks remains the same, and these three issues plus these two issues will create your ROE. This is taken from this website, and this is a question which came. This is a question which I found in your MTP. 2000 December 2000. So it's simple. It's simple. Just you have to have an idea about it, about the formulas and etc. etc. And you can. This is the five-way segregation. This is the five-way segregation, five-way representation. Now what we do is that very simple. These two are new inclusion. These are from previous. So EBIT by sales into EBIT by EBIT. So EBIT gets cancelled, and EAT by EBIT gets cancelled. Sales by assets. So these are old terms. So these are old terms. Sales by assets. So your sales get cancelled, and therefore this term remains. EBIT has got cancelled. And finally, your assets by equity. So assets gets cancelled. So what remains is EAT by equity. So what remains is basically what remains from here is basically your earnings after taxes by equity. This is what remains, and this is what your ROE stands for. This is what your ROE stands for. And here, the first term comprises of the operational efficiency. The second term comprises of your interest burden, tax burden, asset utilization. So this is about asset utilization, and this is your equity multiplier. This is your financial leverage and your equity multiplier. And a little bit about each of the ratios, which you can, if you want, you can read at a point of time. And I have considered a case study. Of course, this is from your study notes. And we calculate the common return on equity, and we calculate the 5-component analysis, and of course we comment on that. And this is again, I calculated that. So this is our this is the ROE. The simple ROE is this, and then we do the 5-component analysis. This is the way I did it. You can do it. Okay, a little bit. Be careful. Your net income is given. So your net income is given. So you add. So I'll just little bit. So your net income is given. So this is your PAT. You add your tax expenses and your interest expenses, and you get your EBIT. So this calculation you have to do prior to solving the sum. And here also we did the sum. EBIT we calculated 2.56. We put the whole issue there. We got 42.75. And this is a ratio which we got. This is a representation of leverage. This is a representation of your asset utilization. This is very high. This is very high. So your asset utilization is very high. Asset utilization is high. Okay. And this is your this is your interest burden, this is your tax burden, and this is your margin of taxes. You can understand the components analysis. So this sum is given in your study notes. Be careful about the implication. Please be careful about the implications. I wrote it in my ways, and the tax burden is of course like this. If the figures are given like this, it is very difficult to comment on a standalone figures if you don't do any comparisons with your previous year figures or your benchmark from the industries. But that may be a part of your answer, but you got to make your implications point wise. So if it would be good if you can give it point wise. Well, I have also included a sum on a three-way analysis, and you are given with a balance sheet. You are given with a balance sheet and an income statement. So this is the income statement and the balance sheet, and so I'll write this is the income statement. I know you can understand, but still, and this is a balance sheet. And on the basis of this, the figures are given. You do a three-way classification. I did the three-way classification, and this is what is coming. The return on equity is this is for 2001 and 2002. So it is increased. But why it has increased? Why it has increased? The profit margin has increased from 0.02 to 0.047. So it's good. It is good. The profit margin is increased, but very less. Asset turnover has also increased from 3.2, and actually your leverage has decreased. So this is a good sign. Your leverage has increased. Number one, profit margin has increased. Number two, asset turnover increased marginal. Increased marginally. And most important is your leverage, or I'll call it equity multiplier, because it's the opposite. Equity multiplier has fallen sharply, which is a good sign. Signifying lower risk. So Any question, anybody? So you can just put your questions if you want. Uh, so if you want, you can put your questions, or you can just directly message me the questions, mail me the questions, as the case may be. Uh, these are the questions on your DuPont analysis. I have gathered up some questions on DuPont analysis. I have also included some hints, so you can just go through that at your suitable time. Uh, there are 5 questions of. I'm not going to talk about this further. The RONA model. The RONA model is return on net asset model. This is also, as kind of asset utilization direct. This is better because if we talked about your asset turnover. So in your asset turnover, it was basically your sales by assets. That means this gives for if you have 100 rupees an asset, how much sales you are generating. But this is a better connotation. This is a better connotation. Better connotation. Why? Because of the simple fact that this is a direct. It shows that what income you generate as regards to your asset which you are utilizing. So this is a better connotation of your utilization of an asset. So basically, a RONA model is all about utilization of an asset. And in asset turnover, you will say we already did asset turnover, but in asset turnover it was how much sales you are generating, and now you are doing how much assets you are generating. So that is a better connotation of your asset turnover. Uh, well, what I will do is that I will I'll off my video because it will give me a better bandwidth. Please excuse me because I'm going to off my video. So this is your asset connotation understanding which we talked about. I have so again here you are doing understanding of net income, and as we have already talked about, your net income is basically your EBIT. Your net income is basically your EBIT. Sorry, minus your interest and minus your taxes. So this gives you your EBIT. This gives you your EBIT. And I've taken a sum. I've solved the sum for it. Implication, again, implication is important. Your implication is important. Implication is if it is high, that means you are using your assets effectively. You are using your assets effectively. Low means you are not using your assets effectively or efficiently. So it shows you your operational efficiency. So RONA model it gives you understanding of your operational efficiency. Gives you an understanding idea about your operational efficiency. It is high, you get again unless until you do a comparison with your benchmarks. So there has to be a benchmark, industry benchmark. You compare that with, for example, XYZ has a RONA of 25%. Is it good or is it bad? We don't really know unless until we compare it with our benchmarks. Or we compare it with our other previous year figures. So you have to compare, otherwise you will not be having an idea about your operational efficiency. Benchmark and bench trending, this is well mentioned again. Please refer to study note. But my perspective, benchmarking is basically comparison. So both are basically comparisons. So I'll say both are comparisons. So both are basically comparisons, and one is, as the name suggests, trending is about years, number of years. Benchmarking is comparison with, for example, industry benchmarking is comparison within oneself, comparative with competitors, functional, with various functions of the supply chain, and strategic benchmarking is, to you compare yourself to the leaders in the industry. Of course, follow your study material. And bench trending is, you look at the trends, and you have to have a clear idea about how your performance matrices are, looking, how the key performance matrices. So basically, it is about looking into your KPIs, how they're changing over the period. So that is the main perspective, how they're changing over the periods. And the point of comparison is important. You have to be careful about the point of comparison. Benchmarking is about external comparison. So bench trending is an internal issue. So benchmarking is comparing yourself with organizational leaders. Bench trending is about yourself. Bench trending is about yourself. The focus is external comparisons. It is about bench trending is about, trend. You are looking at the trend. So basically, it is comparing against own benchmark over the years. So against own benchmark over the years. Wonderfully stated. So you can just, frequency, very important. Benchmarking is done, it is almost a continuous, a benchmarking it is periodically done. You suddenly compare yourself, but bench trending is a continuous process. You have to, it's basically line charts. You just basically, these are line charts of your KPIs. So this is basically your line charts of your KPIs, how the KPIs are moving over the period. But this is conducted periodically. After the result has come out of the student, the mother compares that with the result of of another student. So that is about your bench trending. This is a very interesting perspective which is not mentioned in your study note. Please be careful about this area, which I did, because we are going to talk after this about, the study note talks about TQM, the study note talks about Six Sigma, the study note talks about PDCA, the study note talks about lean management, and of course your SQC. Now, what I have done is that I tried to cover up all the issues together, and when it happened, and what were the main contributors, who contributed to them. All of them are basically improving your operational efficiency. So I will say all of them are basically improvement of operational efficiency. So very important to understand that all of them, that is TQM, Six Sigma, PDCA, lean management, statistical quality control, all of them are basically ways of improving operational performance. Because as I said, if you look at that diagram, that revenue, price into quantity is your total revenue, and you always are in the point of increasing your total revenue. So if you are into sorry. So if you are just thinking about increasing your total revenue, then you have to you have to increase your prices, which is quite impossible in given the market conditions, or you have to increase your sales, your quantity. But if you want to increase your quantity, you have to think of the market, which we are going to talk about in the next module, and keeping your quality okay, because you have to improve your quality if you, on your of your products, otherwise it would not be selling that much. So you have to be very careful about your increasing your quantity, quality. 20s was when the SQC started with Walter A. Shewart. He was the person who introduced quality circle statistics. So this was the first time uh, statistics was used to denote whether your production was going beyond your statistical limits or not. So statistics was used to denote that. And of course, the PDCA, which come a little bit later, really was started by Shewart with his Shewart cycle. So the Shewart cycle is basically prior to the PDCA, Plan, Do, Act, Check Act. Simple. PDCA is simple. There are a number of philosophies, etc., 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 which are given in your study notes. I've also tried to cover the issues, but the issue is very simple. You know, the point is very simple. For example, this class which I am taking, I planned it for a number of days. I planned the class, and now I prepared the document. So I did it. I did prepare the document. And while I'm talking, I'm checking what are the mistakes I made in preparation of the document. And on the basis of that, I will act for the next class. I'll try to better the next class. So this is basically a cycle in which you try to improve yourself, as simple as that. So it was again started during 20s and 30s. But this became a very key component in 1950s when Edward Deming put it into his, 14 principles and of quality. He put it into quality management. And it was during this period of time when your TQM developed. Of course, the statistical issues of Stewart were used. And very interesting thing happened. This Deming, this Mr. Edwards Deming, was the quality guru in America. He was sent to Japan for delivering some lectures on quality. And Japanese systems took over the talks of Denim, and they made it a religion to be very quality conscious, and subsequently the developments of quality started happening in Japan instead of America. But of course, then Juran took over in 50s and 60s. So TQM is a lot of things, but of course, as you know, that quality and Toyota's car manufacturing is very much relatable, and quality is a very important perspective. Six Sigma, so it was during 40s and 50s, 50s and 60s and 80s and 90s where TQM, the principles of total quality management, developed. It is about quality and how quality is managed. And since we are talking about totality in quality, it is not only about your product, it is about your process, it is about your human being, it is about how you treat your human beings. So quality in every perspective. Six Sigma is latter developed with 1986. Bill Smith of Motorola developed it. And 50s, Toyota started your Toyota production system, which is called TPS. And this TPS later became lean manufacturing system. So it was 50s and 90s. In 1990, a book came up, The Machine That Changed the World, where lean management was articulated. Who are the main contributors? You have an idea of that. And again, at around that time, all these things were happening together. The total productive maintenance, it is about your machines. So I'll say this is about your machines. This is about maintenance of of machines. So what we generally do is that when a machine is broken down, breaks down, maintenance stuff takes place, comes. But this book published by this Nakashima of Japan in 1971, where he outlined the principles and methodologies of the TPM, states basically, I haven't gone through that, but basically he says that you have to maintain every day. It is your task every day to maintain your machines so that it doesn't breaks down. So basically you will be saving on a lot of things, saving on your shutdowns, etc., because you're going to regularly maintain the issues. Six Sigma is one of the first issues. Again, now we are moving to data driven, because all these issues are dependent on your data and how you utilize your data for improving your quality. And basically what you do is that if you just look at this, you will be having an idea about your Six Sigma. Now, this is the mean. So let us consider that 12 is the mean. So your mean is 12. And your standard deviation is standard deviation is is 1.5. Standard deviation is 1.5. So what this normal curve says? No, first of all, you have to assume that your production scheduling, the defects, number of defects, production, so is basically follows a normal curve, first of all. And what happens is that if you are following a mean plus minus 1 sigma method of your measuring your defects, then this is the area which is covered. And if 3 sigma is if you are maintaining this, then you can presume that 68.26% of product would be okay. Production is okay, is quality approved. But if you are maintaining mu plus minus 3 sigma, that means it will mean that 99.73% of production is okay, is defectless. So you understand that as you move from 1 sigma to 2 sigma to 3 sigma to 6 sigma, and they want to move to 6 sigma, and that is why the term is coming, you will be reducing your number of defects hugely, and that is the target, to reduce your number of defects. In terms of defects, look, if you are maintaining a 3 sigma situation, your defects per million per opportunities, so DPMO is a consideration of defects, your 3 sigma, so in a million per opportunities, your rate of defect is 66,807. But if you have moved to 6 sigma, sorry, your number of defects should come down to 3.4 defects per million opportunities. So that means if you are producing 1 million products, your number of defects would be 3.4 merely, and it will come down from 66.807. So for example, a dot pen producer, if he's producing 1 million opportunities or million pens, and he is he's maintaining 3 sigma, then it is expected that 66,807 products should be defective. But if he's maintaining a 6 sigma attitude towards his scheduling, then he only 3.4 defects is available. Now, why you are doing this? Because you want to be the leader in the market. And so these are the principles of course, it is not that easy moving to, so it is not that easy if you want to move from 3 sigma or 1 sigma to 6 sigma. It is not that easy. So you require a lot of, you require a whole lot of change, And this is the methodology this is being used. This is the methodology which is used. You can easily look into. You can look into your study notes for a detailed understanding. Uh, the key players who plays the role of so this question has come in. So be careful about this. 6 players are there, 5 players are there, and the master black belt is a main. He's highly trained, and under him you have black belt, and of course this is the person, the leader, the CEO or the CFA who sponsors to possess this thing. And yellow belt are, they are people who are not much who just have basic understanding for the benefits of six. Of course, the main target, remember that the target is to become defectless and create competitive advantage. So everything you are doing is because of this. Everything you are doing is because of this. Challenges. Lean management is again one way of eliminating waste. You want to. It is not about reducing. You want to eliminate waste. Just go through it, and if required, you could just mail me. So there are the key tools of lean management. I'm going a little bit fast because I want to put a little bit more efforts into my other issues. So please bear with me. So these are the key tools of lean management, and these are the benefits of lean management, the challenges, lean management in action. Now this is important. This is important conceptually. Of course, this is not given in your study material. TPS, lean management, as you have said, that TPS is the earlier version. So lean is a latter version, is an academic version, but Toyota has been doing this, and this is called the TPS, which is the pioneer of lean principles. It's a cultural shift. So it is not about. It is a cultural shift. Statistical quality control, of course, you refer to your study notes, but basically there are differential and inferential, descriptive and inferential. One, you describe the purpose, you look into the data, etc., etc. But what we are doing is that we are doing data. So there are data. So these are the techniques of thing. But please, this is my way of, please follow your study material. Please follow your study material. Regarding this is my understanding of the whole issue. So the inferential techniques. What are the inferential techniques? PDCA, plan, do, check, action. What are the stages? How you. But remember, all of them are targeted to betterment, improvement of operational efficiency, which will create. So again, all of them are targeted. Why? Are targeted to improve your operational efficiency, by eliminating waste. Primarily eliminating waste, of course, and many things. And this will lead to competitive advantage. This is the main crux. All of them together will. This is the managing information system. Everybody has a system. Everybody, the whole organization is covered through MIS, And the digital environment is about data, is about data. So if you are doing your Facebook, if you are doing your Instagrams, eh, remember that people are checking on you and they are keeping your data. So they are creating data points. For example, some days back, I was just searching shoes, woodland shoes, and now whenever I go to the internet, they are bombarding me with advertisements of the woodland shoes. And this is nothing but the preservation of data, the gathering of data, cleaning of data, and on the basis of data, they are using some artificial intelligence or algorithms, and they are trying to pursue me into buying something. So they know exactly who I am, the business houses who are data driven, who can use that system, and they are targeting to increase that queue. So as I said, total revenue is nothing but multiplication of your price and quantity. Price, you cannot do much thing about it because it is market related, which we're going to talk about a little bit in the economic efficiency of the farm unit 3. But regarding quantity, you always try to sell more. You always try to sell more quantity. And in selling more quantity, how you're going to go through it? You have to improve upon your quality. And that has been what we have been talking about. So all the systems are covered in your management information system. So this is, there are a number of, for example, the Barnard Marr book. So this book you can follow. You can just look into, this is freely available in the internet. Bernard, you look into this person has has a number of books, and many of the links are given in the study notes. So you can just click on the study on the e-version of the study note, or you can copy and paste that into your browser, and you can just have a look at how things are changing. Significance, it's a hugely important issue. Total productive maintenance, as I have said, is about maintaining. So it closely resembles, of course, it is a proactive approach. It is not a reactive approach, as you saw in total. So it's a proactive approach. Proactive. That means you take action beforehand. So it's not a reactive, not reactive. Very important that you do not, I'll just give you a basic example. You put on your mosquito repellent. That is a proactive approach. So in apprehension of the fact that the mosquito can bite you, you take a proactive approach by plugging in your mosquito repellent. But if a mosquito sits in your hand and you slap it, kill it, then that is a reactive approach. So that reactive approach is once that has already happened. So this TPM, TQM, whatever you call about the Six Sigma or everything, you have to be proactive. Now this is a very important. This is again taken from the internet, and this is I found it. This is interesting to differentiate between. So this is parts per million. So TQM, in TQM, you are thinking about the quality. Here you are thinking about the TPM. This is nice because you readily understand what TPM is all about. So TQM is software oriented. This is hardware oriented because you are talking about your machines. So here we talk about the defects, and here you talk about wastes and losses and waste, because if your production breaks down, then it's trouble. So this is the motives of TPM, etc. The uniqueness of TPM, the benefits of TPM, total quality management. Again, I'll ask you to look at, please be careful about your study note. So again, the theoretical issues, I would request you to abide by your study note. because you know do not have much books. You can read them, because but it is better to go by your study notes. So you can just read, and if you have any problem, you can query me. How we developed the elements of TQM, objectives of TQM, advantages of TQM, limitations of TQM. This is the Deming's 14 principles, 14 quadrant principles. This is a good read, one-page document. It's a good read. You can read it in your spare time. Now let us come to data envelopment analysis. I would like to give some time on this. Now, first of all, in Unit 1, we talked about productivity. We talked about productivity. Where we said productivity is nothing but input-output ratio. So it's basically output by input. That is, so it is, so productivity is nothing but output, how you are producing by your input. Input is, of course, your resources. So the resources you are using is the perspective of productivity, and nothing extra, nothing more. But in efficiency, we look a little bit farther, and we try to, so this is only about your output input ratio. So it is your input to output. So I'll better write the opposite. That is output to input. So this is the basic ratio, input to output ratio, input to ratio. But here we might be tempted to talk about internal process. We might also talk about minimizing wastage. Sorry. Minimizing wastage. So there are more, of course, this is also an output to input ratio, but we have to talk about how you minimize processes, optimize processes. So optimizing processes, and you minimize your waste. And so here it is, a blind man. How much input you have given and what is the result. So we will be more tempted to talk about efficiency in our regular day-to-day affairs in this sessions. Now, here there was a single input and a single output. So in our unit 1, we talked about a single input and a single output. So what about other issues? So if there are multiple, so there can be multiple outputs. What about that? Or there can be multiple inputs. What about that? How do we do it? How we consider efficiency? How we calculate efficiency regarding that? For this, we have to first of all understand what a DMU is. A DMU is a decision-making unit. So a decision-making unit can be so it is basically organization, a part of an organization or the whole organization for which you are calculating that efficiency. So DMUs or decision-making units are the first important point which are to be considered in DEA. So DMU can be, can be a department, can be for example, a company has, a finance company has retail housing loan department, has car loan department, has retail loan department, has credit code limit. So a DMU can be a comparison of all the 4 departments. Maybe it can also be 2 hospitals can be compared with, 2 nursing homes can be compared with. So multiple issues, and we have to calculate the relative efficiency. So efficiency in relation to the others, there was a question which has come in the year, and it is a non-parametric technique. That means you do not assume any kind of normalcy, or it is not a distribution. It is not a distribution, uh, and therefore it makes lesser assumptions, and it relies. So, for example, it is as is given in your study notes, or as much as we can talk about. We cannot go into the details, or it is not required for you as well, but you just know that you have to really, in a subsequent period, use linear programming, because you have multiple outputs and multiple inputs, where you try to use them to give you better efficiency. And you have to identify a frontier. I'll show you how you identify a frontier. I'll just give you the basic of the ideas. So you identify a frontier, and on the basis of the frontier, that frontier is benchmarked and other DMUs are compared with. So basically we will have one input, one output, one input, two outputs, two output, one input. So there are a number of combinations. I'm just going to give you a basic of it. Your books covers, your study material cover a little bit extra. And remember that if it is more than more than two outputs or inputs, then you have to use linear programming to come out with the solutions. Now, your basic step is to gather data. Fine. Then you basically have to be consistent with this. This normalization has no idea, no understanding to your normal curve. What we are saying is that your unit of measurement has to be consistent across different inputs and aspects. Now, very interestingly, it doesn't mean that it has to be same as regards to inputs and as to outputs. For example, in here, for example, your if your value added, if your output, for example, if your output is in rupees, your input can be in hours, but it has to be consistent. But generally, it is easier if it is also in rupees, then it is easier. But this is possible. This is possible. This is possible. So you normalize units of measurement has to be. This is a nice book which you can follow. It is available in the internet. An introduction to data envelopment analysis, a tool for analysis, and most of the material which I have created, or a little bit of the themes which are taken in the study notes as well, are taken from this book. What is a DMU covered? What is non-parametric methods I have covered. So hopefully you will understand these issues. You calculate the efficiency score. So DEA uses linear program, which is beyond our immediate understanding. So we will not be using linear programming to solve it. We're just going to create the ideas. So it will the programming will maximize the efficiency score, which we are not going to do. We are going to just create the idea of how the DMU is, how the efficiency frontier is created. So be careful about this point. This is how the solution is made, but it is beyond the study note and beyond me as well. I have to do a lot of understanding as well. Now let us take a simple thing, which is given in your study note. This is the 4 situations where the employees are given in thing and in numbers, and the sales are given in rupees. So as I said, that can happen, and it's the tau efficiency. The tau is measure of efficiency. Time is the effort of efficiency, and you measure the ratio of sales to employee, and you find that this is the highest score. That means the store D has 44,000 employees who gives a sales of 44,000. So it's an equal ratio. It's a great ratio. Now this is again from your study notes, and we just make the point. So it is basically a scatter diagram. So it's basically a scatter diagram. And it's basically a scatter diagram, and you draw this line. And this is your efficiency frontier. This is your efficiency frontier. The line where it is highest. That means every firm. This is a benchmark. This efficiency frontier conceptually is a benchmark. That this is possible. This is possible. It is a benchmark that this is possible, and all other firms will try to move to that, conceptually speaking. What you can do is that since this is a scattered diagram, I said this is a scattered diagram, you can draw a line of best fit. So you can draw a line of best fit. That you can do. So this is a scatter diagram, and you draw a line of best fit, and this is the line of best fit. So this is the line of best fit. Now, why this is done? To make you understand that the efficiency frontier is something else. Efficiency frontier is the line which connects the best possible. This is the best possible scenario. So this is the best possible scenario. And you have the line of best fit. So, and which is also a regression line. And here we have calculated using the usual formula from Microsoft Excel, linest formula you can use to calculate the line of best fit, and it is come to 7.756. So this is the fundamental difference between statistical measure of regression and DE. So in DE, we calculate the best scenario. Just take an example of a single input and single output case. And here you have the input, which is, the input is given in $1 million. It's from a foreign authored book. And the output, the value added, which is an output, is given in $1 million as well. And so these are the you are requested to compare their performances, and of course what others are going to talk about, I'm just going to show you. So you calculate the efficiency score. So you calculate not only the efficiency, you calculate the efficiency score of firms A, B, C, and D. So you calculate the efficiency score of firms A, B, C, and D. Now these are the efficiency score. These are the efficiency score. And you find that this is the highest, 0.209. That means A is the best firm as regards to the efficiency score, giving you a score of 2.09. Now what we do is that you calculate the relative efficiency. So you calculate the relative efficiency. That means if this is 100, so you take this to be 100, and what about the others? So this would be, these are the efficiency scores. These are the efficiency scores. And these are the relative efficiency. So if this is 100, what about this? And what about this? And what about this? So basically, you do the relative efficiency, which is nothing but considering the firm A to be 100, what about the others? So you have the efficiency scores, and these, now we can set the performance targets on the basis of a efficiency score. That means if this firm wants to be this firm, what will happen? For that, we calculate the input target. So input target is nothing but the actual input into relative efficiency by 100. So the input target is 9.955. That means if farm B wants to become as efficient as farm A, then it must produce its output, which is basically 2.2 units, million of capital employed. It should reduce it by and make it as 9.55 billion. So this means that farm B operates using 9.5 million as input, produces 2 million as well, then it will be as efficient and as fast. So that means you can have an input slack. That is the difference between actual output and input target. So farm B has a input slack of, that means it is using a input of this much, but if it can use this much, then it will achieve the same output. So as a percentage, it has to improve. So this is percentage improvement required. So if it as regards to input, similarly it can do this as regards to output as well. So as regards to output, so if it increases, if it decreases in input by to the tune of 56.59%. So if P decreases inputs by 56.59%, then it will become as efficient as farm A. So again, this is adjustment of input. This can also be in terms of output. So output targets and output slacks can also be adjusted. And that means it will have to produce more. So if you look at this, you calculate output target. If you have for farm B, output target is 0.46 billion, and it is producing only 0.2 billion. So it has to increase its output by 1.26%, and that means it has to produce at 130.41%. So what it is producing, it has to produce more given the level of output, and that is to become as efficient as farm A. This can also be now in this same sum. If you increase this two inputs, so in the same sum we add another input. So if we had another input, what is going to happen? Here we include number of employees. So number of employees in terms of 1,000 is farm A, farm B, farm C, farm 6. So the main point is that since there are two ratios, we have to have the same numerator. You cannot have the same denominator. The output cannot be same. So that means we have to have inverted reciprocal. Very important perspective. You have to have the reciprocal of the ratios. So it should be value added for employees, and now it would be how much employees is required, how much value added is required for the employees. So this is the ratio we will use in this scenario, and this is a scenario, and here you have to have the lowest. So farm C is the lowest and farm A is the lowest as regards to your capital employed, and as regards to employees, this is the lowest. So as regards to employees, this is the lowest, and so farm A is lowest as regards to capital employed. That means So you have to calculate the reciprocal efficiency ratios, and value added remains the same. So if you are putting in one value added, if you want to produce one value added, what is the capital employed you require? You require the lowest capital employed. And if you are thinking about the employees here, the lowest employees are required in 0.929. And in this case, you have to do a efficiency frontier. So there was a in our previous case also efficiency frontier, but that was a line. But here you have this line as the efficiency front. Since you have and the two ratios here, you have one situation, and value added is employees to value added. This is considered in x-axis. Sorry. This is considered in x-axis, and this is considered in y-axis. So I just do this graphically because linear programming I'm not going to talk about, which is beyond the syllabus. It is not maintained in the books as well. So you do this, and you know that you have created the efficiency frontier in case of two situations. So this is frontier analysis, and all the data are enveloped in that. So this is this, and I have a little bit of time left. So I'll spend a little bit of time talking about talking about our, just give me a minute because I'm going to share this unit. So I understand that this is a little bit too much for you in a 2-hour session to talk about it, but you can have a leisure of talking about it. You see 10 minutes of it, and then give a break, and then see other again 15 minutes or half an hour of this, and then take a break. So let me do my job, and now we talk about our unit 3, and that is economic efficiency of the firm. So I have with me maybe 20-25 minutes of time. Again, you have a classroom. You can join the classroom, and you will get the document through this directly. Otherwise, I will give all these documents to the institute, and you can have it through proper channel. But many questions are coming from this unit, and here we again, these are all performance analysis. Again, it's a performance of the firm. If you just refer to my first day class, I said that if you look at performance analysis or performance management, you will find about your employees, but it is about the firm. So our topic is about the firm. We are talking about the firm performance. So it is about the firm performance we are talking about. And if you are talking about economic efficiency, the term economic efficiency, if you look at your study note, you will find that when they talk about economic indicator, it is a little bit, from the perspective of the country as a whole. So how you measure the economic perspectives, what indicates that the economy is bettering or worsening, etc., etc. So if you look at this, you will find that the first unit, it is an indicator about the economy. So it is a larger context. So you have to think about the larger context in this scenario. So in the larger context, you have the leading indicators, which leads the situation. You have lagging indicators. And these are, these are from prior to you understand that there is something going to be wrong in the future. So you try to understand what is wrong. You get this data and you know that something is happening. For example, the GDP percentage is going down in the last 3 years, means is something is bad is happening. Lagging indicators, on the other hand, oh sorry, I just said the opposite. Sorry, very sorry for this. So this is this leads in, so you can forecast your economy on the basis of the leading indicators and economic trends. So these are basically historical. So your lagging industry are basically historical perspective data on historical perspective, and these are parallel. So this gives you a snapshot of the current economic condition. So this is for the future, this is historical, and this is current. So this is the idea about the, but and these are the common economic indicators which we're talking about. But till this, in your study material as well, we are talking about indicator as such, but we are not interested in that, really speaking. We are interested in the farm. So we are interested in the farm. So we are interested in the farm. As you know that we are not interested in the economy or anything like that. We are interested in the farm. And why we are considering this? Because we are interested in the competitive advantage of the farm. Because if the farm is efficient, it will be reflected in its competitive advantage. It will sustain the business by maximizing profit. And so these two goes hand. It can go, if they are going hand in hand, then it's fine. If you are lowering your production cost, and if you are increasing your profit, then you will be sustaining. So you will be sustaining your business, and if you're sustaining your business, you will be able to gain competitive advantage. So basically speaking, these two leads to this, and sustainability leads to competitive advantage. So it should have been written in a different pattern. Efficiency, economic efficiency as such can be productive efficiency and allocative efficiency. Allocative efficiency we are not concerned with, because it maximizes societal welfare. So we are not concerned with that. What we are concerned with is productive efficiency. That means all the farms are at their best. They are producing at their production possibility frontier. So they are doing their best. So how we came from economic efficiency? Economic indicator indicates how the economy is going. But we are not concerned with that, because economy is a huge area. But we are concerned with what a farm is doing. A farm as such has two kinds of efficiencies: allocative efficiencies and productive efficiency. Productive efficiency is when a farm is doing its best as regards to the resources it has. That means it is utilizing its resources to the fullest extent. And if all the farms in the economy does this, then the economy is said to be in an allocative efficiency, whereby societal welfare is maximized. Now, we are, of course, as I've said, we are talking about the farm. Regarding the farm, how is it doing? How is the firm doing? If we want to know how the firm is doing, how is the firm doing? If we want to know this, we have two issues to talk about. One issue specifically, and what is that? KPI. So in the first class, I give you an annex on what KPI is and what are the various KPIs, key performance indicators. And it is, as you understand, it is hugely important. It is not only market share, it is not only, it is, huge customer satisfaction report, employee satisfaction report, etc., etc., etc. But KPI, before KPI, there is another indicator, which is your critical success factor, CSF. So you have to, if you want to grow, what you got to do? Maybe you got to do well in your table management, if it's considering a restaurant. So that is a key factor. So you identify your critical success factors and you look at how you have performed in your KPIs. So critical success factors are beforehand. So these are beforehand. And these indicate. So these are after the thing. So look, in examples include sales growth. Is sales growing? What was the sales in the previous year? 2 crores. How much it is right now? 2.221 crores. How much is inflation taken place? How much is the profit? So you exactly understand customer satisfaction. So you try to, for example, Flipkart and etc., or your online banking, State Bank of any bank has a customer satisfaction report. So you might be casual. I might be very casual in giving the number or answering the questions, but they keep track of all that. Employee productivity, profit margin, etc., etc. So these are, I gave you an exhaustive list of what KPIs are in my first day class. So this is a very important understanding. This is a very important point. You try to understand the difference between key success factor, critical success factor, and KPIs. And if you look at this perspective, it is quite clear. And please refer to annex list of KPIs in my first session. So I gave you a list of KPIs in my first session. You can refer to that. So look, CSF are standalone. That means you create your CSFs. And I'll just give you examples of CSF. For new product launch, market research, effective marketing, product quality. In a manufacturing company, supply chain efficiency, quality control. So it's like what we have to do to be good in this business. So what I have to do to be good in this business of teaching, I have to, etc., etc. So the issues we think about when we are thinking about what we have to do to be good is CSF. And KPIs, well, some students said, it was good, your session was good. Some students said you have to improve in these issues. So these are KPIs. So CSF is, is the factors on which your success depends, and KPIs are the indicators. So these are standalones and depend. So 20% profit doesn't matter much. You have to benchmark it with other issues. These are qualitative, very important. These are quantitative. use insights, generate insights. So, you use insights of what can be, how can be. Now, this is a very interesting caselet which I have covered up. And this is a situation I'll just read out. In a strategic goal, if the strategic goal of a restaurant business in the forthcoming year is to increase its profit by 5%. So it wants to increase its profit by 5%. With a corresponding increase in throughput. Throughput is processing. How quickly you can process. So you want to process various issues, preparation of foods, number of customers served at lunch hours, number of customers served at dinner hours, etc. Throughput. The meaning is given in this study note, in this footnote. This So these are the CSF and KPIs. Now we want to go. We want to give the CSF and CPIs because this is the strategic goal. This is the strategic goal to increase its profit margin by 5% and to increase its throughput by 10%. Of course, you can say that increasing its throughput would also increase in its profit because you are becoming more efficient in regarding your internal processing, and therefore you will increase your profits. What does it matter much? CSF are the critical areas to focus. KPIs are the matrices which you have to regularly monitor. And now we identify the CSF and the KPIs in regards to menu optimization. That means which menu which you should have. In regards to operational efficiency, maybe serving the customers, kitchen management, staff training, minimizing time waste. Marketing and promotion, how you market your things. You have done some marketing which is useless. Your marketing, your promotional activity should be well targeted, and so on and so forth. Customer satisfaction, so how they are satisfied or not. So you try to understand. So these are the CSF, and these are your key performance indicators. Profit margin, you look at the corporate throughput increase, daily target, menu profitability, table turnover rate, how quickly things are changing. So I just tried to identify some of the issues. Maybe you will be able to put in a better situation. So this is about your CSF and KPIs. Now we are coming to profit optimization. Regular questions are coming, 2 marks, 7 marks questions are coming on this issue. You have to be very particular about it. I have 10 minutes left, so maybe I am unable to cover up this by today. So the next day, on the 1st of December, I will be covering up the balance of it. Though risk management is a huge issue. Again, I will cover up a huge document, but I may be talking about some of the issues. But here also, this I must cover up very well. So we are talking about profit optimization. Now, optimization is maximization and or minimization. So conceptually, profit has to be maximized. So since this is given in your study notes, I didn't want to change this, but I will surely say that profit is to be maximized. I will surely say this. Doing nothing. Profit is to be maximized. Of course, there can be critical situations, but I will say optimization includes the term optimization includes maximization. So optimization is maximization or minimization. So profit is generally maximized and cost is minimized. So you try to minimize your cost and maximize your profit. Both together we call it. Very simple issue. Profit is given by revenue minus cost. So, and cost is total variable cost by plus total fixed cost. And profit is, so revenue is quantity into profit, and cost is total variable cost is your VC into multiplied by quantity. Sorry, plus, very sorry, plus total fixed cost. Very simple. So total revenue is sum of, because you know you can sell many units, so this is the sum of P into Q, and AR is so this is very interesting. Total revenue is equal to price into quantity, but average revenue is just nothing but total revenue by quantity. So you know, multiply divided by average. So it's, so what you do is that total revenue is equal to P into quantity divided by quantity equals P. And marginal revenue, which we'll be talking in details, is the first order derivative of very sorry, with respect to Q of your total revenue function. So this is first order derivative of your price into quantity. So here it is again, it is price. So average revenue and margin. So this is happening in when the firm is a price taker, When the firm is a price taker, that means a competitive market. Regarding cost, I must tell you that we all know, we have done this, that this is the total fixed cost, and the average fixed cost is this is the fixed cost per unit. That means average cost, fixed cost per unit, and the variable cost is like this. Sorry, what I'm doing. Sorry, very sorry. The total variable cost is like this. This is the total variable cost, and this is the quantity. You measure this in quantity. X-axis is quantity, and the per unit total variable cost is this. So this is a per unit PVC. But interestingly, this is cost in cost accounting. This is cost. But just a bit. So as I was saying that this is the usual thing we do, but here the cost is straight line curves. The total costs are all straight line curves. So this is not the case in case of, this is in economics. This is not the situation. So in economics, this is not the situation. Well, this is we have 3 minutes left, and I will take up the matter the next day. But it's a very interesting area, and remember that this portion is regularly coming in the examination in the form of 2 marks question or 7 marks question, etc., etc. So maybe I'll start from a little bit earlier, and I will delve maybe 1 hour on this issue, and maybe the rest of our on Unit 4. Of course, I will have a very comprehensive document prepared for you on Unit 4, because Unit 4 is on risk, and it should be dealt seriously. But I understand that this kind of 2-hour sessions is maybe too much for you. But remember, just take this as as synopsis of the whole study note which you have in front of you. So it's a synopsis of what we have covered up in your study notes. And of course, this material which I have prepared for you is an addition to what you already have. If you have any contradiction with your book and with your study notes and this material, I will request you to follow the study material. Hopefully not. And you can also, message me, or you can also come through the proper channel and request me for detailing some issues if you are if you find them to be contradiction with the study notes you have. But generally, I have my study notes when I'm preparing this, so I don't think there will be any contradiction to it. So I have done a lot of issues together today, maybe a lot for you to digest, but you can take it in 15 minutes or 20 minutes slot as per your wish when you have the whole video with you. So with that, hopefully I don't have any question and answers or chats. So I don't have any. And with this, I thank you all for this, and I meet you on the 1st of December with the last session. Thank you very much.
Okay, thank you, sir.
Thank you. Thank you.